the only thing that we have left over to talk about within the syllabus is really on alternative investments. But in terms of, you can't not talk about financial markets without talking about the potential for conflicts of interest and the problems these conflicts of interest create. So when you talk about conflicts of interest, right? When we say conflicts of interest, what that means, it's a problem when you have a person or an institute that has multiple objectives. This is what we're going to talk about. That has multiple objectives, and there are conflicts between these objectives, right? And this is what happens sometimes in financial markets. Market service providers have different institutes, right? And within these institutes, there are multiple objectives which can create conflict, especially to the investor, right? So, for example, the cases where, for example, in the US, we spoke about Enron, and I refer to Enron a lot in this section because we will look at a small video on the Enron collapse as well. But Enron, the seventh largest company in the US, which collapsed in 2001, essentially, a lot of it occurred because of conflict of interest. And if the conflict of interest didn't just happen within the company, where the company was providing false or misleading information to the investors, it also happened with all related parties to the company, like, for example, its auditors, its investment banks. And so it was not just the company who was complicit in providing these false or misleading statements that ultimately led to investors losing a lot of money when the company collapsed, right? Ultimately went bankrupt because the investors were investing in thinking that this company, based on data, thinking that this company's had a different picture, right? That it was doing well, when in reality it was not. And for that picture, for the investors to get that picture, there were a lot of information that was presented, and it was not just presented by the company itself. And this is the problem, right? This is where you have multiple interests. Institutions have multiple interests that need to be served. They need to take care of their shareholders, right? They need to make profits. Who will ultimately benefit from those profits? Their shareholders. But also they have to serve the public interest, their corporate clients, right? So when you have all of these different types of stakeholders involved in an institution, you will have different objectives for each type of stakeholder, which can result in conflict, where each of these objectives or interests can work against each other in certain situations. Especially situations where you are looking at profitability for your company versus the best interest of the investor. And this is the problem in financial markets. If you don't balance the two, ultimately what would happen, the investor will lose out. And if the investor loses out, this is where we come back right to the beginning of the whole course, where we said you lose faith in the system, you lose faith in financial markets. What would happen? It stops the efficient transformation of economic activity, where then flows will not pass from the haves to the have-nots, right? Investors will stop investing. Markets will not function efficiently. Therefore, borrowers, lenders, people who want to raise money will not be able to raise money from different sources of funds. And therefore, their cost of funds will be higher. Potential cost of funds will be higher. There won't be efficiency in the economic transmission system, right? So why do you have this conflict occurring? One of the reasons is because we say a lot of the time, these financial intermediaries provide different types of services. We call these where they try to reach or realize economies of scope, not economies of scale, economies of scope. What is the difference? What is economies of scale? that you all have heard of, right? Economies of scale.
The size, basically.
Yes, well, the reduction in costing that you can get because of the size advantage, because you're providing to more people, therefore you reduce your providing services or goods, manufacturing goods for by larger quantity, and therefore you can get cost advantages in terms of the fact that you're manufacturing larger. So it's only your variable cost, but your overhead, your fixed costs are the same, and therefore ultimately there is an advantage that comes to you. Similar way, economies of scope is about providing different types of services and therefore enhancing your profitability by providing different types of services to the same investor. Okay? So you try to tap the same investor, but by providing different types of services. So, for example, sometimes rating agencies provide consultancy services. Sometimes you have investment banks and stockbroking companies and fund management companies. A lot more. You see all of these types of institutions working together, meaning under one umbrella holding company, right? So here you're having both buy side and sell side features, buy side and sell side features, or buy side and sell side services being provided to the client by the same group, by the same holding company, right? So you have one holding company, and then you have within that holding company, you have the investment bank, the stockbroking arm, the fund management company, the commercial bank, the insurance guys, right? So these are what we call universal banks. So that's another example of where you try to achieve economies of scope, where you try to provide the customer or give the customer all services under one umbrella. That's not a bad thing. That's actually a good thing for the customer, right? What you have to be careful of is, what the institution needs to be careful of is, there is very high potential for conflict of interest. So they need to make sure that there are safeguards, because while one side is trying to sell a product, the other side might be trying to buy a product. There might be more incentive to make certain things, to buy products that are issued by the sell side of that company, even though they're not profitable, and then sell it to their clients. There can be incentives that occur when you have these universal banking type structures where you have multiple organizations of both the buy side and the sell side working together. What do you mean by buy side companies? I think we spoke about this when we spoke about investment banking. What do you mean by buy side and sell side? Yeah. Buy side companies and sell side companies.
Buy side is where the capital is the guys who are looking for investments. Sell side is where the parties are selling securities and raising money or raising the capital for clients.
Correct. Yeah, exactly. So buy side is where you're working on behalf of your clients or your company to invest, right? To that was said, to look for investments. So you're buying. You're on the buying side. Versus on the selling side, you're selling these financial products. So examples of sell-side institutions are stockbrokers, investment banks, because investment banks, remember, they help clients raise money. So they're a sell-side institution because they're helping clients raise money. So they're selling their clients in terms of they're selling the ability of their clients' repayment capacity. And they are doing a service where they're saying you should invest with this person or this company. They are issuing a commercial paper or a securitized paper or a debenture or whatever that product is, or shares through an IPO. This client is doing this, and they are a good client in terms of they have these capacities. So you should be investing with them. So they are selling a financial service, right? So, for example, stockbrokers, investment banks. Buy side is where you are buying financial services on behalf of your clients or on behalf of your parent company institution. So like fund managers, insurance companies, pension funds, right? Again, in that fund management universe, a lot of the time, that's where you have your buy side. Now, when you have a universal bank, for example, you will have all buy side and sell side, all the companies working together. You'll have the fund management company, you'll have the investment bank, you'll have the stockbroking companies. And there can be conflicts that can be created because of these economies of scope that you try to achieve by providing the same client different types of services. Doesn't mean it will be. This is where we're talking about the potential for conflicts of interest. So, there are 4 areas that we identify that have the greatest potential. It's not that there are no other areas of conflicts of interest that occur, but the greatest potential for conflicts of interest, right? Why do conflicts of interest occur? We know that it's because of asymmetric information. So because information you know that others, your clients, your investors don't know, it could be that you're selling them a product that is subpar, for example. It could be that you're buying on behalf of them a product that is not as good or subpar because your group company is selling them. So this is the problem where you have asymmetric information. This is where you have the biggest potential for conflicts of interest. And we identify 4 financial service activities that harbor the greatest potential for conflicts of interest, which include underwriting and research in investment banks, right? Now, remember when we say underwriting, remember investment banking, when we did that lecture, we said in these textbooks, when you talk about underwriting, you're not talking about shares that are left over in an IPO and you're buying them. No. Underwriting is the activity of raising funds for an IPO. Remember? It is the activity of raising funds for an IPO. So underwriting is where you're helping a company raise money for an IPO, which could be firm commitment or best efforts underwriting. Right? But it is not underwriting like we define in Sri Lanka, where we talk about underwriting in terms of firm commitment, where you have a bank that will say, in case the shares are not sold, we will buy the rest. That's not what we're talking about here. So your investment banking activities, where you have underwriting and research activities within an investment bank, where you have accounting firms offering auditing and consulting, both activities, right? Audit activities as well as consulting activities. Where credit rating agencies, again, do the same thing, credit assessment as well as consulting, and then universal bank. These are the 4 main areas of activities that we're going to talk about. So, for example, there have been case studies that have, there have been instances or episodes, right, where you see a lot of the time people working in investment banks in the US who have been identified, penalized, sometimes gone to jail, sometimes paid fees, penalty fees, in terms of not giving the best recommendations to their clients. So this is a case example, the King, Queen, and Jack of the Internet. These are about 3 analysts, right? Henry Blodgett, Jack Ruppman, and Mary Meeker. Working at Henry Blodgett worked at Merrill Lynch. Jack Ruppman worked at Credit Suisse Boston. Mary Meeker at Morgan Stanley, right? So, oh no, sorry, I think Jack Ruppman is Solomon Smith Barney, probably. Solomon Smith Barney. So, these people, they were essentially investigated. They were analysts. So they were giving stock recommendations. A lot of these analysts, specifically during the tech bubble time. So they were giving a lot of stock recommendations in terms of tech stocks, right? And under investigation, when they took up their email records and everything, they found, although they were giving buy recommendations on certain companies, they were sending out emails within the company within their colleagues. They were sending out emails trashing the company, right? Saying that this company is really not a good company to invest in. And then they were putting out published reports, essentially saying buy. Great company, by recommendation, by report, right? So what are you doing? Although you don't believe in the company, you're giving out recommendations where you're creating business for the company. So this is one problem that occurs in investment banking or in terms of research, especially where investment banking has stockbroking arms, right? They will both, one, underwrite new issues, and they will provide research. In terms of the stockbroking arm, they will provide research, buy-sell recommendations to the public, right? And with research, the problem is research arms are cost centers most of the time, right? Research arms are cost centers. They don't make profits. They provide research. But who makes the profits? The investment bank makes the profits. The stockbroking makes the profits, right? The investment bank makes profits by the fact that they are doing an IPO. They're selling the IPO to their clients. And if the IPO is successful, then the client, obviously you have your success fees, you are raising the total amount, and then you get future businesses. So there's a lot in stake in terms of investment banking, where you're charging higher fees to raise funds on behalf of a certain company. And in case you are unsuccessful, you don't want your research arm to go and give a bad recommendation. But neither should the research arm if they do not believe that this company is a good company, or they don't believe that this company has the ability to pay back, or there are other problems with the company. They should not be putting a buy recommendation where people will read the buy recommendation and believe the factors that you have displayed as positives for this company and buy the company. Because ultimately what will happen once the IPO comes into the market, once this company starts trading, share prices will fall. And when share prices fall, who loses out? Investors. I purchased this share at a higher price, at let's say 10 rupees, and now the share is 8 rupees. I lose out, the investor. So these guys, especially Henry Blodgett and Jack Brugman, Mary Meek ultimately could not be convicted. They couldn't find enough evidence against her, but they were investigated, and 2 of them were convicted, penalized, I believe, because they had internal emails that were going around that were essentially saying that these were not good companies to invest in, and externally they were giving out buy recommendations for the company. Then in the US, when you do IPO underwriting, there is this big problem that you have. Remember I said in the US, how does underwriting happen a lot of the time? It's a lot firm commitment underwriting, where the investment bank buys the shares to their book and then allots it to their customers, right? Even if it's not the investment bank, even the stockbroking companies, they will buy the shares to their books and allot it to their customers, right? So in the US, when you have an IPO, what would happen? The investment bank would buy the entire quantity of shares. Remember, we spoke about this in detail when we were doing investment banks. So company X is doing a share issue. Instead of going directly to the public, they sell the shares to the investment bank, and then the investment bank will sell the shares to the public. Now, how will they sell the shares to the public? There will be a portion that is allotted to retail investors, sure, but most of the time, these would be sold again to other stockbroking firms, where the public will come and apply through those stockbroking firms. And then the stockbroking firms will allocate, as well as the investment bank will allocate the shares to their clients. And sometimes these shares are allocated not in the, like in Sri Lanka, how would you work in an IPO? You would apply, right? You would say, you would have an application form and you would apply and you would say, this is the number of shares that you want. And the company would, depending on how many times oversubscribed the share issue is, the company would say, okay, based on the level of oversubscription, we are going to allot the shares in this manner. So retail investing public gets this much shares, and the institutional public gets this much shares. And for every 100 shares you apply, you get 80 shares allotted to you, for example, right? So there is an allotment process. If there is oversubscription of a share issue, there is an allotment process and everybody gets their allocation evenly. Retail investors get a different allocation, maybe from larger scale investors. Larger scale investors sometimes get smaller allocations because of the scale of the investment that they have made, but everybody gets the same allocation. Not necessarily the case on how it might happen in the US, right? And because of that, what happens is sometimes investment banks have been found to do what is called IPO spinning, where they have hot issues, they allocate it to their preferred clients at the expense, obviously, of other clients. So they have preferred clients where they want to do future business with them, or they are continuously doing business and they're generating good profitability for other clients. So what do? You allocate higher shares to those clients versus some of your other clients might get left out, or lower number of shares might get allocated to them. So why does this practice happen? We call this practice spinning. Spinning means you allocate at the IPO price. Generally, we say, remember, the IPO price is at a discount. Most of the time, IPOs come at a discount. You have to check whether that discount that the company is saying is correct or not. But most of the time, IPOs are offered at a discount because it is the first time they are coming to the market. And therefore, they offer a small incentive to investors to say, come and invest with me. Because this is the first time I'm coming to the market, I'm giving you a discount to my correct price, right? So they give you an incentive to invest with them. So unless the IPO market is very hot, in which case the discounts disappear, most of the time you will see IPO first day, there is a additional gain that you can make on first day trading, because most of the time IPOs come at a discount. And this is what got exploited in the US. So what happened was these IPOs that were coming at a discount gets allocated, and doesn't get allocated sometimes in a fair manner. It gets allocated more to certain customers than other customers. And then when it gets allocated more to certain customers, what will those customers do? They will go and immediately sell it. First, they're selling in the market, make a big profit, and they're happy. And therefore, future business will always come to this investment bank, right? But what do you mean by spinning? Spinning means quickly spin around and record a quick profit, right? Spin it around and record a quick profit. IPO, discounted price, gets allotted to your account. You take it, go and sell it in the market at a higher price because it's a guaranteed or near guaranteed, right? It is not guaranteed because you don't know how the market will react, but it is near guaranteed because usually IPOs are priced at a discount. And therefore, you can always sell it in the market most of the time at a higher price. So you sell it at a higher price and you make an immediate gain. This is what we call IPO spinning. So this actually on the Wall Street Journal, there was this article long time back, that came up. That was a recorded telephone conversation between investigation that happened on IPO spinning. So here, Frank Cotrone. Frank Cotrone is an investment banker that was working at Credit Suisse First Boston, and in 1993. So you see, it's a long time ago, right? And this is an article that came in the papers during that time, where it's a recorded conversation between him and Michael Dell. Michael Dell, CEO of Dell Computers, right? So July 2000, between Frank Cotrone and Michael Dell, where Cotrone says, my team has gotten word that you're personally interested in having Dell Ventures receive meaningful allocation on the IPO of Corvus. So Corvus was some company that was just doing its IPO, right? And Dell says, yeah, we'd like 250,000 shares of Corvus. I know there have been efforts on both sides to build the relationship, and an offering like this would certainly help, which is essentially saying, allocate more to me and you will get business in the future. So through the So this is what we were talking about when we talked about IPO spinning, right? Where, for example, IPO is priced at $20 a share, but after market starts trading on trading day, it surges to $50 because the IPO came at a discount. Right? Securities get allocated rather than when the securities get allocated, you allocate it to your preferred clients and you allocate it at the IPO price of 20. And what does the client do? They immediately take it and sell it. That's what we call spins it to make a gain. Okay. And why do you do this? To keep relationships. You give it to your best clients to maintain relationships so that you're hoping in the future by giving them this. It's a very, how do you say, different way of giving a bribe, right? It is not an outright bribe. You're giving a potential for you to get higher returns because you don't know what will happen on the first day. But you're giving somebody preferred allocation at the expense of everybody else. So other people, other retail investors will get hurt because they could have made that $20 to $50 profit. Now they have opportunity lost because they are never even allocated the shares. So those are a couple of examples of how there is incentive between underwriting divisions and research divisions of investment banks to where there is conflict of interest, right, between underwriting divisions and research divisions of investment banks. Some other examples that you can talk about, actually, you see when you look at the video of the Enron collapse, right, the Enron collapse. And there, actually, one analyst got fired during that Enron case. One analyst got fired because he was giving sell recommendations on Enron. He was saying there's something wrong with this company and you should be selling this company. And the investment banking arm, I believe this is probably Morgan Stanley. You see it when the video comes. So the investment banking arm was not happy because they were doing a lot of business with this company. And ultimately, within the group, this analyst got fired because he was giving sell recommendations on a preferred customer of theirs. And the preferred customer was not happy because the company, Enron, at the time was actually on a spree to promote their company name and to make the share prices go higher in terms of, it's not share manipulation or anything. It's the fact that they wanted the share prices to be higher, obviously because of share compensation plans, stock options, and so on. And they didn't want anybody giving out sell recommendations. So they pressured the investment bank, essentially. They were saying, some of your guys at your other company are giving out bad recommendations. Why should we be giving business to you? And ultimately, that analyst got fired. So you see that as we look at the video later on. And then the second one, auditing and consulting in accounting firms. You know that accounting firms don't just do audits, right? So a lot of the time now, you have consulting arms. So what do you think is more lucrative? Auditing work is more lucrative or consulting work is more lucrative? Corporate advisory work. Yes. Consulting work is more lucrative, right, than auditing. Auditing is essentially you're providing a service that there are multiple people who are providing this service. There is high competition. It is not a value-added, it is an essential service, but not a value-added service. Versus consulting is not an essential service, but it is a value-added service where you can make premium, you can charge premium pricing. So obviously there is very high incentive if you're doing both the auditing and consulting. I think now there are restrictions in terms of if you're an audit client, in terms of how much consulting work and the type of consulting work that you can do to your audit clients. There are certain restrictions. I'm not sure exactly what, but there are certain restrictions that are there. At the time, for example, when Enron was collapsing, there was a lot of consulting work being done by their auditor. And therefore, there was very high incentive for the auditor, actually, in that case, to hide the true picture of Enron. Because when Enron was not doing well and they were trying to give audit opinions, Enron would say, but if you give me a bad audit opinion, I'll stop all work with you, auditing and consulting everything. And because they didn't want to lose their consulting services, they didn't disclose everything, or they didn't give a true and fair outlook of the company. Ultimately, this auditor, Arthur Anderson, collapsed. They were one of the oldest auditors in the US, and they essentially collapsed. Right? They are no longer there. After the Enron collapse, they were also one of the first to get hit because everybody lost trust in them. They would have helped the company destroy records, conceal certain information. Right? So this is the problem when you have both auditing and consulting provided by the same company, and one is more lucrative than the other. Same thing in investment banking and research, right? Research is an essential service. It's a value-added service for your clients, but it is a cost center most of the time because you're not charging for giving that research, right? It is a value-added service that you provide, but most of the time it is free of charge. Versus, where are you making the profit? You're making the profit in your trading, you're making the profit in your investment banking by providing that consultancy services, right? And there is very high pressure, a lot, even in Sri Lanka. There is very high, I'm not talking about even in Sri Lanka. When I say even in Sri Lanka, not where you have groups of investment banking and this conflict of interest of the same institution. But I'm talking about in general, any stockbroking firm. How many sell recommendations do you see being published? Very few. And even those stockbroking firms who do publish their recommendation later on find it very difficult to approach the company again to get a good research meeting. Because companies, they don't give the research meeting after that. They say, you had a research meeting with me last time and you gave me a sell recommendation. I don't want to meet you again, essentially. So they get blacklisted. So therefore, a lot of research firms are not, it is not about even conflicts of interest. This is simply about the fact that they are not incentivized to provide sell recommendations. So therefore, you will probably never get a picture. You will get the buy recommendation when it's time to buy, but you will most of the time will not get the sell recommendation when it's time to sell, because it is not in the best interest of the long-term business or to get long-term information about the company for the researcher, and that is not even with conflict of interest. That has nothing to do with getting business for the other division. That is simply for the research arm to have continuous access to the company. So accounting firms and audit firms, same way, the same problem occurs. We don't see that in Sri Lanka because a lot of the Sri Lankan credit rating firms still don't offer consultancy the same way, but credit rating firms in the US do offer consultancy services, just like audit firms. They do offer consultancy services as well, right? So in addition to credit ratings, you can engage credit rating agencies for other work, to get other work done, other consultancy services. Right? And again, credit rating is the basic, would be the basic bread and butter of your company in terms of providing steady revenues and steady margins, but the additional revenues and the higher margins will come from consulting. So because of this, there is incentives sometimes if you're providing both credit rating and consultancy, then you won't give a downgrade as easily as if when you are independent. If you are not providing any other services to the company, you would probably give a downgrade much faster to a company than if you have other services which might get jeopardized in case you do something that the company does not like. Interestingly, you know that in the early days when it started, consultancy firms didn't used to get paid, credit rating firms, not consultancy, credit rating firms didn't used to get paid by the company. Now today, you know, audit firms get paid by the company, right? To provide a clear and fair picture to us, the investor, they get paid by the company who they are auditing. Provide a clear and fair picture of the ability to repay their debt. Credit rating agencies get paid by the company. So there is obviously there a little bit of conflict because you are getting paid by the person you are providing the credit rating to give a picture on behalf of somebody else. So those days when it started, credit rating firms actually didn't get paid by the company. They got paid by the investor. An investor who wanted to invest in the company used to engage a credit rating firm to do an independent evaluation of the company and come up and say, so the investor would pay. Investor would pay and say, tell me how this company is looking. Should I invest it or not? And that's very, arm's length, right? The company is not paying you. The credit rating agency is engaging with the company directly on behalf of the investor. So that's very arm's length, and that's very, the results would probably be much more fair. But what happened was with, as we go on, this became an unsustainable model for the credit rating agencies because of the free rider problems. You know, free riders who use the information that is out there of other people and take that information and, like, you know, in your assignment groups, you have free riders, right? Who don't do the work, but who will come in when you have an assignment group. There'll always be a couple of people who are not doing the work and a couple of people who are actually doing the work. And there are people who are not doing the work but getting the same grade. They are free riders. Same way, when you have these credit rating agencies who are doing this rating and being paid by this investor, but there are other free riders who will use the same rating without paying the credit rating agency. They will use the same assessment, and especially in this modern day where information is so freely available, and they would go and make an investment in the company. So it was not a sustainable model for the credit rating agencies, right? And few investors paid for research. It was very few investors who actually said, okay, I'm going to pay for this research. So it was not a sustainable model, which is why credit rating agencies had to resort for doing business with the companies directly. Universal banking. Universal banking essentially is a situation, like I said, where you're combining together commercial banking, investment banking, insurance, stockbroking. So all these sell side and buy side operations, you're combining together to create one umbrella, right? You remember those days, the Citibank logo? All services under one umbrella. So that's a great concept for the investor. It is, if you forget conflicts of interest, potential for conflicts of interest. Why do you have universal banks? Because you are becoming a one-stop shop for the investor. For the investor, he doesn't need to go to a separate stockbroker. You, the commercial bank, provides stockbroking services, provides investment banking services. If you, the commercial bank, cannot provide this service, provide a certain loan on your own, you'll call up your investment bank and say, there is this customer interested in taking a loan. My limits are full. I don't want to lose the customer. Do you think we can do something else? And they can work together with the customer, either to do a loan syndication or to do commercial paper for through retail investors or debenture, right? So for the customer, it's a very convenient way where all services are provided to them through one entity. That's why universal banks come into play. But obviously, universal banks are fraught with potential for conflicts of interest. And remember, I keep on saying the word potential because next what we are trying to say is just because there is potential for conflicts of interest doesn't mean that always there will be conflicts of interest, right? If there was conflicts of interest like that, these financial markets would not be in this state. That means that the conflict of interest, although there is much potential, is actually quite low. Actual conflicts of interest are quite low, although when they do happen, they're catastrophic, right? So with universal banks, it's fraught with potential conflicts for interest. For example, it could be that your insurance company within the group, right? Your group's insurance company is selling insurance product which the bank is selling. So other than the insurance agent who are selling the insurance product, through bank insurance channels, the bank staff might be selling products, and there is incentive for the staff to sell products, and obviously there will be incentives provided for the staff to sell these products as well. But if you're not careful, the potential conflict of interest is that you might be forcing people to buy products that are not suitable for their risk return requirements. So, because when you provide incentives to sell products, then what will happen? You might be forcing your customers to buy products that are not suitable for them. So I took that example because in the past we have seen in Sri Lanka a few of these types of problems that have occurred. Then there can be situations where, for example, your investment bank is doing an IPO, and that IPO again is being sold by either your stockbroking company, where your research arm is putting out a very strong buy recommendation, or your bank, commercial bank, again is selling the IPO, saying that you should be applying for this IPO. When it is not a good IPO, if it is a good IPO, that's fine, right? It's not that your stockbroking company shouldn't put out a buy recommendation if it is a good IPO. But if it is not a good IPO, the investment bank is working on behalf of the client. They can always do business. It's up to the buyers to check and buy what is being offered, right? But other people who they place their trust on, like, for example, their stockbrokers, or like, for example, their bankers, who will be selling these products to them, they might not put as much scrutiny as they would for the direct investment banker who would be selling the product, because they know the investment bank is working on behalf of the client, maybe sometimes, right? So that's a potential place where you again might be selling products to clients that are not suitable for them. So security issuers, where they get paid themselves at the expense of the investing public. So these are examples where universal banking can cause potential for conflicts of interest. Now, what I want to highlight here is these situations have actually caused conflicts of interest, right? But doesn't mean that they will continuously cause conflicts of interest, because we have what we call reputational credits. When there is conflict of interest, that means after a while, public stops trusting you. When that trust stops, when you're in the service industry, it becomes very hard for you to do your next business. If you are a credit rating agency which consistently provides bad rating advice, where the public knows this company shouldn't be rated this high, but if you get rated by this agency, you always get a good rating, for example, what will happen after a while? public will stop trusting the ratings from that rating agency. And therefore, what happens after a while is public will start to say, public meaning large institutional investors, right, high net worths, whatever, will start to say, if the rating is from rating agency A, I will accept it. If the rating is from rating agency B, I will not accept it. Right. Reputational rents. It damages, if there is damage to your reputation, you cannot in the service industry continuously keep on doing business. So this is what we mean by reputational rents. Service industry a lot of the time does business through trust. So where you damage that trust, it becomes difficult for you to get your next business and next business. You might get a few, but it becomes difficult for you in the long run. Which is why, although there are potential for conflicts of interest, it's not rampant. The abuse is not rampant, right? It is not always the case that just because that potential is there, it happens. Yes, it could be that there is an IPO happening from your investment banking arm and there is a buy recommendation from the stockbroking company. Can happen. It doesn't mean that the IPO is bad and the stockbroking company is giving a good recommendation. Because if they keep on doing that, later on, what will happen? Investors will stop believing the recommendations that are given by them for even good companies, for even other companies, right? So it doesn't always happen. And it is just because, every IPO is not a bad IPO, right? These are about a few IPOs that are bad IPOs, where the stockbroking company might not be giving a fair picture. But for good IPOs, obviously, the stockbroking company should have the ability to give a fair picture and say it's a buy recommendation. So the point is, just because there is potential for conflict of interest, it doesn't always happen. There is evidence to say that public discounts recommendation from underwriters or stockbroking companies that are associated with underwriters. They don't put as much weight to it. If the underwriters or the investment banks, stockbroking company puts out a recommendation, a lot of the bigger investors will say that's by that company, so let's exclude that and look at what the other stockbrokers are going to say. There's a discount that's attached to a research report that comes by a company that the investment bank is working IPO for. The problem becomes where your stockbroking company is giving out buy recommendations or sell recommendations, when your stockbroker or investment bank is doing not so public issues, right? Where they're doing certain transactions for clients, private placements, for example, and they want those sold, and there is no gauge for the public whether this is actually because of an internal transaction that's happening or whether this is an independent report that is being published. But if this keeps on continuously happening, then what happens? People stop trusting the reports that are published by these brokers. So skip that. Because what happened was, really, I'm not going to go through this, but after the collapse of Enron, there were these acts that came in to essentially the Sarbanes-Oxley Act and the Global Legal Settlement Act. Essentially, there was a lot of oversight that came in for investment banks. And Sarbanes-Oxley actually, for a while, now it is no longer the case, but at that time, it stopped universal banking. They essentially said that you can't have both the types of banks together, right? So, is it here? Let me just check. See, Sarbanes-Oxley prohibited public accounting firms from also engaging in non-audit activities. And then they severed links between underwriting and research firms. And then there was independent research that was required in case there was an IPO activity that was going on. So there were a lot of things that came in, and it's not written. Why is that not? Sarbanes-Oxley itself stopped investment banks from having universal banks. So for the longest time, because of this act, universal banks couldn't operate. And later on, there were amendments that came in, or the act was rescinded, which means that now again you see these global universal banks operating. So just in terms of conflicts of interest, how do you remedy that? Just because there is conflict of interest doesn't mean that you have to remedy every single conflict of interest, because remedying conflict of interest means remedying potential conflict of interest means that you are exacting a cost on the financial system. When you try to preempt and stop something from happening before it happens, there is a cost to that. And sometimes that cost might not be justified. Sometimes you just have to let the market do its own thing. So existence of the potential for conflict of interest does not mean that this conflict will happen, nor does it mean that it will have, even if it happens, have severe consequences. If you try to eliminate that conflict, actually, you might stop the flow of information for other things. So because of this, we look at different ways of remedying conflicts of interest, and we think about every single way is not justified for every single activity. But there are 5 ways that we identify. You can try to remedy conflicts or potential for conflicts of interest, right? Leave it to the market. That's the lowest cost solution. Don't do anything, leave it to the market, because the market knows. The market knows when they see one rating agency giving better ratings consistently versus another rating agency consistently, the market knows to discount that rating and say, no, but I can't trust that rating. That rating agency is saying AAA, when this rating agency, if they had gone to that rating agency, they would have got a lower rating. Market will discount that information. So they will not trust it. So you will allow the market to solve the problem, because that reputational rent would mean that market will not keep on trusting. But problem with this approach is it's very low cost. There's nothing to regulate. You let the market decide by itself what it wants to do. Let the market forces decide and give that discount. But market has short-term memory. Market doesn't remember for long periods of time. So then what happens? After a while, you forget. After a while, you come back, do the same thing, and the cycle keeps on repeating. You think we have never had Sakwitis before? You know, the Sakwiti scam that happened. Recently also we had similar scams that happened. Before also you have had similar scams that have happened. We keep on continuing to have the same cycle being repeated over and over and over again. Pyramid schemes. It's not the first time it has happened. It will not be the last time it has happened, right? It's very difficult to regulate because they can pop up anywhere. But by letting the market forces regulate it, it is difficult to regulate, to be quite frank. But by letting the market forces regulate it, you will see that continuously there will be cycles, market will fall for pyramid schemes, people will lose money, a lot of people will suffer. And then the cycle, and they will then, by suffering, not put their money in anything high risk again. And then another set of people will start to do the same thing. And the same cycle will keep on going. Sakviti was one type of scheme. There have been schemes before him. Large institutional clients, there have been schemes after him. Large institutions. Right now, these schemes are even worse because it is now online. It is even more difficult to track. It is even more difficult to identify because they are now online. But if you are in part of a scheme where you're being promised returns which are impossible, they are probably impossible, right? So the problem with leaving it to the market is that market has short-term memory. So what do? You regulate for transparency. That's the next step. You regulate, but not a lot. You regulate for transparency. So you regulate mandatory disclosure. Slightly more costly, right? If there is mandatory disclosure, that means that, for example, all banks, whether listed or unlisted, you have to publish your accounts in the papers every 6 months. Primary dealers must publish their accounts. Finance companies must publish their accounts, right? Listed or unlisted. You regulate for transparency. So you provide the information. It's up to the investor to read that information and figure out, is this finance company or bank or whatever going through some problems? Why is this company not making the type of profits that it should be making? Should I be investing in this company? Up to the investor to figure it out, but you're providing that information. It is more costly for the company because they have to take out a full-page ad in the papers or a half-page ad in the papers, put that information out there, get their accounts audited on time. All of that is required, right? It's slightly more costly, but slightly more regulated. More information is available for the investors to make a better decision. Supervisory oversight. Third phase, even more costly, right? Here you provide private information. Public information is out there through transparency disclosures, right? Like, for example, what we were talking about. But you have a CBSL regulator, CBSL as the regulator for banks, IBSL as the regulator for insurance companies, SEC as the regulator for unit trust companies, who will provide private information to these supervisors who will act on it if it is necessary. Private information in the sense banks provide information on a daily basis, monthly basis, right, weekly basis. There are certain sets of information that are provided to the central bank. Higher costs. There are high costs associated with having to assign somebody to compile this information, send it out to the central bank, make sure that the information is accurate, gather the information, have MIS systems in place to be able to collect this information. But what are you doing? You're increasing that level of safety for the public. Next level, even more costly, separation of functions. So you separate the functions that create conflict of interest, which is what Sarbanes-Oxley did in 2002. They separated the investment banking activity and essentially prohibited universal banking, right? Where they said investment banks can't have these functions associated with them. So you have to be standalone entities. What happens? It's highly costly because why did these functions start in the first place? To have economies of scope. There are certain cost advantages that came from having all of these functions together in-house, right? There were economies of scope. There was advantage to the client. There was advantages in the fact that we were getting different types of clients, okay, in terms of these investment banks. So you separate functions that create these conflicts. So within the same firm, you can't have a holding company that holds all of these different firms together. It's prohibited. And finally, you socialize information production. This is where you have independent authorities, such as in some countries, you have independent credit rating agencies to provide through public funding, through taxpayer money, to provide credit ratings, So, right, or any other type of information services. So I can't immediately, it eludes me, but where you have information that is being provided to you free of charge, remember, it is never free of charge. We are paying for it from our tax money. Because how do you get information that is free of charge that is disseminated by the government, by any government, right? How do you get that? They have to recruit researchers. They have to recruit people to get this information, compile it, disseminate it, right? So nothing is free. You are still paying for it. And socialization of information production is the best remedy for conflict of interest because there is no conflict at all. It is completely independent, but it is the highest cost because all parties, all public starts to pay for that information. Any questions? So like I said, it's a very short section, but before we move on, let's just look at a quick video of the Enron collapse. That kind of gives you a synopsis of all of these different types of conflicts. Okay, it's about a 20-minute small clip. That's a condensation of a lot of things that happened. This is a longer video, right? This is like a 1.5 hour, 2 hour type of documentary about Enron's collapse called The Smartest Guys in the Room. So for anybody who can type it on Google, it's available on YouTube, Smartest Guys in the Room. This is a condensation or condensed summary of that. Am I screen sharing? Can you see my screen now? What can you see at the moment?
We can only see the presentation.
The presentation.
The presentation slide, the slides.
Okay. Thanks. You can see the media player now.
Yeah.
I believe the only venue for me is the Ride of Broken Dreams. Oh, you mean the Enron ride? Let's go. Enron hit the national psyche. It hit it as sort of the time-tested lesson, and that is if it looks too good to be true, sometimes it is.
We're all gonna be rich!
Broke even.
Enron Online will change the markets for many, many commodities. It is creating an open, transparent marketplace that replaces the dark, blind system that existed. It is real simple. You turn on your computer, and it's right there. That's our vision. We're trying to change the world.
So you can see that, right? Can you hear it and see it? If you can't, just let me know.
Yes, yes,
please.
yes.
Okay, thanks.
What's he building in there? What the hell is he building in there?
It had taken Enron 16 years to go from about 10 billion of assets to 65 billion of assets. It took them 24 days to go bankrupt.
What the hell is he building in there?
This company collapsed so quickly and so entirely. I mean, it was into bankruptcy within a matter of weeks. It just immediately had all the makings of a gigantic scandal.
He's hiding something from the rest of us.
The fatal flaw at Enron, if there is one, you say it was pride. But then it was arrogance, intolerance, greed.
So many of them were blinded by the money that they didn't see that they were sinking their own lifeboat.
We have a right to know.
It just got hungrier and hungrier. Sooner or later, they were doomed to go off that cliff at 90 miles an hour.
It's astounding that they got away with it for so long.
In reality, Enron was a house of cards.
What we didn't know is that the house of cards had been built over a pool of gasoline. It all sort of became smoke and mirrors.
Committee will come to order. This is a case of America's largest corporate bankruptcy. The question here is what happened, who was responsible for it happening, and what can we do to prevent this sort of thing from happening again?
I think the Enron story is so fascinating because people perceive it as a story that's about numbers, that it's somehow about all these complicated transactions. But in reality, it's a story about people, and it's really a human tragedy.
I do not believe I did not do anything wrong that was not in the interest. And all the time that I worked for Enron Corporation, that was in the interest of the shareholders of the company.
That's the CEO.
Ultimately, who was responsible for the downfall of Enron? Only a few years ago, Enron was the nation's 7th largest corporation, valued at almost $70 billion. Pundits praised the company as a new business model. This trading floor was manned by America's best and brightest, charting the futures of energy and power. And high above each with a private staircase, Ken Lay and Jeff Skilling had built their own plush staterooms. They were known as the smartest guys in the room, captains of a ship too powerful to ever go down.
In the Titanic, the captain went down with the ship. In Enron, it looks to me like the captain first gave himself and some friends a bonus, then lowered himself and the top folks down in the lifeboat, and then hollered up and said, by the way, everything's going to be just fine.
According to published reports, your husband
Chairman.
earned about $300 million in compensation and stocks from Enron over the last 4 years. What happened to all that money?
It's gone. It's gone. There's nothing left.
This is the shredded evidence we got that came out of Enron.
We very quickly determined that the insiders had sold off $1 billion of their stock in the preceding several months.
Did you convert stock worth $66 million?
I don't know, but I don't
Would that be surprising to you to learn that you did that?
No, that would not be surprising.
Mr. Fasto got
CFO.
only $30 million in stock proceeds from Enron, but he took another $30 million out with his side deals.
I think there was just an immediate sense of outrage at Lay and Skilling and Fastow when people realized how much they had profited and how completely artificial the appearance of this company had been.
News of shredding at Enron raised more questions. What answers were lost in the torn documents? 20,000 employees had lost their jobs. $2 billion in pensions and retirement funds had disappeared. Was Enron the work of a few bad men or the dark shadow of the American dream? The magic power of deregulation pushed Ken Lay to found Enron in 1985. Through a merger of vast networks of natural gas pipelines, Lay thought Enron would be poised to take advantage of the government's decision to let gas prices float with the currents of the market.
Ken Lay had a view of deregulation from the standpoint of all the money that he thought could be made.
Lay saw in Jeff Skilling the guy who had the answer to what the future of the natural gas business was supposed to be. Ken Lay is also a guy who considers himself a visionary, and he liked other people he thought of as visionaries. He liked people with big ideas, and Jeff Skilling was a person with the biggest ideas of all.
Jeff Skilling's biggest single idea was to find a new way to deliver energy, Rather than be bound by the physical flow of the pipeline, Enron would become a kind of stock market for natural gas. It was a magical new idea. Transform energy into financial instruments that could be traded like stocks and bonds.
So that was the one good idea. In 1992, using that good idea, we became the largest buyer and seller of natural gas in North America.
Skilling saw the opportunity to build an industry new and to start a business from scratch. But he had one specific condition that had to be met before he'd join Enron, and it was that he'd be allowed to use a certain kind of accounting known as mark-to-market. Arthur Andersen signed off and the SEC approved it.
Arthur Andersen's
He
auditor.
really believed that the idea was everything, and that when you came up with an idea, you should be able to book the profits from that idea right away. Because otherwise, some lesser man was taking the profits from the idea that some greater man had come up with in the past.
Americans are making a lot of money in stocks. The stock market soared to near record highs yesterday. The stock market continued its bull run Thursday. The Dow rose at nearly 61 points.
Even the person with very little disposable income all of a sudden began to play in the stock market because nobody could fail, because stock prices were just going up and up and up.
Another day, another record.
And the internet and technology stocks just going wild.
Gained more than 100 points to close at 7,895.81, the highest finish ever.
It was a time where we had the biggest bull market in the history of the world. Ken Lay was right there acting as a cheerleader.
Obviously, our stock has been doing very well. I think there's a fairly good chance we could see the stock price double again over the next year to 18 months.
Enron mounted a campaign to capture the hearts and minds of stock analysts.
The natural gas stocks include Enron.
We're never satisfied, and I don't want us to ever be satisfied with the stock price. It should always be higher.
Enron posted a 30% jump in second quarter profits as web-based trading boosted its wholesale energy business.
The game was played on Wall Street in such an established way throughout the 1990s. As long as a company met or exceeded the analyst projections for quarterly earnings per share, the stock went higher.
The game was called pump and dump. Top execs would push the stock price up and then cash in their multi-million-dollar options.
People at Enron got paid in large part through stock. Everyone had a huge stake in seeing the stock price go up. And it was driven very clearly by the profits every single quarter. They're exceedingly conscious of that. Skilling was, and everyone else in the company was. They posted the stock price in the elevator.
You were surrounded by the health of the company. What's the stock price doing? We were consumed by it.
They continued to sell the company as being a very stable place where it could predictably increase profits 10 to 15% a year. In fact, to get to those numbers, Enron was doing all sorts of questionable things, taking enormous risks.
We like risk because you make money by taking risk.
By all accounts, Enron was soaring. But in reality, profits weren't going up. They were headed in the opposite direction. Enron had vast natural gas operations all over the world. They had cost billions to build, and most were performing terribly.
But in other places in the world, in India, great quarter and great year in India. Phase 1 of Dabhol is in operation, generating power. Phase 2 is financed and is under construction.
My experience indicated there were certain places that you assiduously stayed away from, and one of them, as an example, was India.
They built this power plant in India. Nobody else would do that at the time. They were terrified of investing in India. Enron did it, and did it in a big way.
But Enron had failed to see something basic. India couldn't afford to pay for the power Enron's plant produced. Now, Dabhol is a ruin. Though it lost $1 billion on the project, Enron paid out multi-million-dollar bonuses to executives based on imaginary profits that never arrived.
Mark-to-market accounting.
Where was the real money going to come from?
Of course, the pressure was enormous. You had to come up with the next idea that would break through. Failure was not an option.
Is a big winner today.
One of the things that fascinated me was that almost all of the Wall Street analysts who covered Enron had buy ratings or strong buy ratings on the company's stock.
Why were the analysts blinded to the company's deceit
We relied on the information that was available at the time.
They trusted the integrity of the
Solomon
company's
says smart.
certified financial statements and the representations of the company's management.
And we've been absolutely upfront with the analysts.
Jeff Skilling was the critical component in creating the Enron illusion. Time and time again, when we had a question to the sell-side analysts that they couldn't answer, the response was, I'll give Jeff a call. I'll run this by Jeff.
By giving Jeff a call, the analysts weren't analyzing at all. They were willing to believe virtually anything Enron told them.
Most of the analysts right now have a target price on us from $100 to $115 a share.
Any analyst who didn't buy the company line became an enemy of Enron. Enron's CFO, Andy Fastow, had his eye on John Olson, one of the only analysts skeptical of the Enron story.
Enron loved analyst strong buy recommendations.
Merrill was informed by
Merrill.
Fastow, either you get somebody who is on board with us and has a strong buy recommendation and loves us at the same time, or we don't do any business with you. I knew that my days were numbered.
This is an abuse.
Merrill Lynch fired John Olson. Soon after, Fastow rewarded the bank with 2 investment banking jobs worth $50 million.
Analysts were routinely getting large bonuses from the investment banking departments to bring in investment banking deals. Once that happens, never was heard a discouraging word.
While Enron's stock kept rising, its businesses kept losing money.
As disturbing as Enron's own misconduct is the growing evidence that
Investment
leading
banks.
U.S. financial institutions not only took part in Enron's deceptive practices, but at times designed, advanced, and profited from them.
The Enron fraud is the story of synergistic corruption. There are supposed to be checks and balances in the system. The lawyers are supposed to say no. The accountants are supposed to say no. The bankers are supposed to say no, but no one who was supposed to say no said no. They all took their share of the money from the fraud and put it in their pockets.
Enron paid its advisors well. In 2001, the accounting firm Arthur Anderson received $1 million a week. Enron's law firm, Vinson & Elkins, did nearly as well.
Everyone had their hand out at the table. They were all being paid, and as long as Enron continued, they received their fees. They were a part of the process. So it's hard now to say, oh, we didn't know anything.
Mr. Skilling, your opening statement was extremely compassionate to the employees. And I want to show you a tape, and I believe we have it ready to go. Listen to this.
We invest all of our 401k in Enron stock, absolutely. Don't you guys agree?
401k is their retirement
Why
plan.
is it that you had begun unloading your stock pretty heavily before that date, and yet led the employees to think they should keep buying stock?
Ms. Senator, I have been a major shareholder in Enron Corporation, and you can take the videotape to mean what you want it to mean. I was a supporter of Enron Corporation.
You know what happened to those people. They lost everything.
I feel terrible about what happened to the employees.
While Enron's stock was plummeting, the retirement accounts of Enron's rank-and-file workers were frozen.
We were frozen out of our accounts. It was right about $32, I believe. And over that time, from when it was frozen to when it opened up, I think it went down to 9. We could not access it. And what came out later that was so bad was the fact that Ken Lay and Skilling and all the top people were moving their money then, but we couldn't.
On December 2nd, 2001, less than 4 months after Skilling's resignation, Enron declared bankruptcy.
I remember it was just a strange kind of a surreal day. We learned around 9:30 about the bankruptcy and that we were all being let go. We all felt like we were on the Titanic and the last lifeboats had long gone and we were just now on the sinking ship. We had 30 minutes to leave the building, and at that point, it was no longer like being on the Titanic. It was kind of like being on the Lusitania. The torpedo had hit, and there's 20 minutes to get out.
There was a lot of disbelief. Very few of the rank and file people ever dreamed that Enron would actually go bankrupt.
Andy Fastow pled guilty to conspiracy to commit wire fraud. He agreed to forfeit $23 million in assets. His sentence was reduced to 10 years in exchange for testifying against other Enron executives. In 2004, Jeff Skilling was indicted for insider trading and conspiracy to defraud investors. Pleading innocent, he paid his attorneys a retainer of $23 million to defend him.
Enron should not be viewed as an aberration, something that can't happen anywhere else, because it's all about the rationalization that you're not doing anything wrong. We've involved Arthur Andersen, we've involved the lawyers, the bankers know what we're doing. There's a sense that the diffusion of responsibility, everyone was on the bandwagon, and it can happen again.
Enron's accounting firm, Arthur Andersen, was convicted of obstructing justice. With its reputation for honesty destroyed, America's oldest accounting firm fell along with Enron, and 29,000 people lost their jobs. Enron shareholders are suing Enron and its banks for $20 billion. Ken Lay was also indicted for conspiracy to commit fraud. His attorney maintains that no one has been hurt more by the Enron bankruptcy than Ken Lay.
With today's arrest of Ken Lay, the top echelon at Enron has now been called to account for their crimes. Mr. Lay, you have anything to say, sir? A little later today, I'll know.
Looking at Enron is like looking at the flip side of so much possibility, because like most things that end terribly, it didn't start out that way. It started with a lot of people who thought they were changing the world, and over time they became victims of their own hubris, victims of their own greed. And so it's like taking so much promise and possibility and looking at it in a mirror and seeing the flip side reflected back at you.
I think the larger lesson was what Enron asked of its employees, which was ask why. And, you know, I didn't ask myself why enough. I didn't ask managers why enough. I didn't ask my colleagues why enough.
So Ken Lay actually died of a heart attack before he was convicted. I believe he didn't go to prison. But you see, like so one of the other things that they say is when you should never, or you're not diversifying. If you're investing in your own company, you're not diversifying, right? So one of the mistakes that the employees did, they don't have a separate EPF like we do in Sri Lanka. They manage their own retirement fund. So the company had their own retirement plan fund. So the employees had their pension funds and they had their, they were managing this investment fund for retirement, just like EPF, but it was in-house. And when you say you're putting your 401k there, that's essentially your retirement money, the EPF contribution type of thing that you're investing, but you're investing back in your own company. So we say that's one of the worst methods of diversification, because when you invest back in your own company, if the company goes bankrupt like it did in Enron, or something happens to the company, you don't have your job, you don't have your retirement money, right? You don't have your pension fund. So one of the worst ways to diversify is to, in these types of situations, or when you're having your own investment portfolio, a big part should never be your own company. A lot of the time, people invest in their own company because they think, I know this company. But that should never be part of your investment portfolio, not in a big chunk anyway. Yeah. So you can see there a lot of the conflicts, and you can see the similarities to Sri Lanka as well, right? A lot of like the cases that how things that were happening in Sri Lanka during different periods of time, how they happen, same types of events happen. That's what we call short-term memory and cycles. In terms of, you've seen these things happen abroad, you've seen these things happen in Sri Lanka itself, but the cycles repeat itself. People forget, and the same cycle starts again. Any questions? Okay, so it's 9:45. Let's take a break. And at 10:05, so we'll take an early break and we'll come back for the next section, alternative investments.
Thank you.